Welcome to our overview of the Tax Cuts and Jobs Act of 2017, which was signed into law on December 22, 2017 by President Trump. Today we will cover the tax impact to employers and their employees that the tax law have on certain fringe benefits. Today we're going to talk about transportation benefits, moving expenses, meals and entertainment, employee achievement awards, compensation with regard to executive excessive employee remuneration, and then qualified equity grants. We'll also be talking about some strategies employers may employ to kind of address these issues and the changes that they're going to be facing. Transportation benefits have significantly been changed by the tax law. Under prior law, an employer could deduct the cost of certain transportation fringe benefits provided to employees. These types of transportation fringe benefits included parking, transportation passes, and van pool benefits. These benefits provided by employers were excluded from employees' income. These are monthly indexed amounts, and for 2018, the monthly amount is $260 per month. Beginning in 2018, the employer deduction for qualified transportation benefits is fully disallowed. This means the employer no longer gets a business deduction for providing any type of qualified transportation fringe benefit. However, this does not impact the employee's participation in a program that allows pre-tax deduction for their cost of qualified transportation, and it does not include any income if the employer were to continue supporting a transportation fringe benefit program. So what this means is if the employer decided or determined that they were going to continue to offer and pay a portion of a qualified transportation fringe benefit for their employees, while the employer would not get a business deduction for that benefit, the employee also does not include that in income. So there is, the exclusion was maintained for exclusion of income for employees. There's one change for tax-exempt employers, and the change is that if a tax-exempt employer provides a qualified transportation benefit to employees, that is now subject to the rules on unemployment, unrelated business income, and so that will now be part of their calculation for unrelated business income. Moving to bicycle commuting reimbursements, under prior law, an employer was allowed to provide a $20 reimbursement to employees who commuted on a monthly basis. For 2018, that qualified bicycle commuting reimbursement is fully disallowed, which means employers no longer can offer that on a pre-tax or no-tax basis to employees. Employees would have to take it into income if, in fact, they do offer that benefit. So, you know, in looking at some of the benefits that are being offered under the transportation area, many employers are still going to continue to provide these benefits. They're just going to have to look at the tax impact a little bit differently to their business and to their employees. Moving to moving expenses, under prior law, an employee could exclude qualified moving expenses that were reimbursed by their employer from their income. So this is one of the provisions in the tax law that does sunset. So beginning in 2018 through 2025, qualified moving expense reimbursements that an employer provides to an employee are fully taxable to the employee. So while the employer may still offer these reimbursement expenses for moving to the employee, they will now be considered and part of the employee's wages subject to all employment tax and federal withholding. There's one exception to this, and it's for members of the armed forces on active duty pursuant to a military order, and the move has to be a permanent change of station. One more moving exception for taxpayers or individuals, they were allowed under Code Section 217 to exclude or to take advantage of a deduction for moving expenses if they moved at least 50 miles further away from their current residence. Beginning in 2018 under current tax law through 2025, so this is another provision that does sunset, the taxpayer deduction for moving expenses is suspended. And again, the code, tax law under the new provisions, did allow for members of the armed forces on active duty to move or who move under a military order for permanent change. So they did allow for some exclusions for military members. Going to meals and entertainment, this has changed dramatically and will require some attention by employers on an immediate basis. Under prior law, an employer could fully deduct expenses for recreational, social, or other similar activities, primarily for the benefit of non-highly compensated employees, and provided that the activities related directly to the conduct of the employer's business. So this had to be a business-related expense for recreation, entertainment, those types of business activities. The regulators felt that these types of entertainment expenses on behalf of the business may have been a little bit too subjective and possibly open to interpretation by businesses and employers. As a result of this sort of take by the regulators, beginning in 2018, this entertainment deduction is fully disallowed. So businesses will no longer get any type of business deduction for entertainment, amusement, recreation, membership dues, clubs organized for business, or any type of facility used in connection with those types of activities. The employee exclusion remains unchanged. So entertainment expenses are now disallowed under the new Tax Act. Moving down to meals, this has been partially repealed. So under prior law, an employer could fully deduct food and beverages that could be excluded from an employee's income if those benefits were de minimis in nature. In addition, there was a 50% deduction for food and beverage expenses associated with operating the trade or business. These are retained. So if you go out for business meals, you have employees that are taking clients out or they're working, there is still the 50% exclusion for business tax purposes or deduction. That has been retained. However, what has been changed, and this is a expansion of the 50% rule, beginning in 2018, the deduction for food and beverages that can be excluded from an employee's income also goes over and moves into the operation of an employee cafeteria located on or near the employer's business premises. So the employee income exclusion remains unchanged. However, the 50% food and beverage exclusion now moves over into the cafeteria or any other type of operation that the employer has that offers meals to employees. This is further, the Act goes one step further and basically says any amounts provided to employees at the convenience of the employer incurred or paid after December 31st, 2025, they will be completely disallowed. So for those businesses that have cafeteria opportunities or other types of related food items, those deductions will be sunsetting for the convenience of the employer. Some changes in the Employee Achievement Award. Most of the exclusions or changes here really talk about personal tangible property. And so under prior law, an Employee Achievement Award was limited to $400, and it was basically an award of tangible personal property. This term was not clearly defined under prior legislation, and the IRS regulations now define this to mean tangible personal property. And tangible personal property is items such as gift cards, and other pieces. The Act further defines tangible personal property in this context to exclude cash equivalents, gift coupons or certificates, as well as vacations or meals and lodging, tickets to sporting events, stocks, bonds. So items that are actually held as tangible personal property are excluded. A higher limit applies to qualified plan awards, and the qualified plan awards are different than employee achievement awards, and a qualified plan award has to be given to employees under a written plan. It may not discriminate in favor of highly compensated employees, and there are some additional limitations, and the qualified plan award limit is $1,600, $1,600. The cost of achievement award for an employer deduction cannot be more than $400. However, if it's under an employee achievement award up to $1,600, that award is still a business deduction and is non-taxable to the employee. Beginning in 2018, the employee's exclusion and employer's deduction for employee achievement awards do not apply to cash, coupons, vacations, etc. In other words, employee non-taxable or non-tangible personal property items are now included as compensation to the employee. However, the employer may offer certain types of benefits or coupons to the employee where the employee can go out into a catalog and select some of these items for purchase. So there are some significant changes to the employee achievement and employee qualified plan awards. The limitations themselves have not changed, but how the interpretation of the tangible personal property and how those definitions are used are changed within the new tax code. Moving down to compensation for employees, executives. Under the current or under prior law, performance-based compensation was excluded from the $1 million or $1 billion annual limitation with respect to deductible compensation. So under prior law, a deduction for compensation paid or accrued with respect to a covered employee of a publicly traded corporation was limited to $1 million per year. The deduction limitation did not apply to commissions or performance-based pay, and that included stock options. Under prior law, for purposes of the deduction limitation, a covered employee is defined by the IRS to include the principal executive officer and the 3 highest compensated officers other than the principal executive officer at the close of the tax year. So the pre-reform IRS definition did not include the chief financial officer. However, for Securities Exchange Commission, or SEC, the securities law defines a covered employee to include the chief executive officer, the CFO, chief financial officer, and the 3 highest paid employees other than the CEO and CFO who were serving as executive officers at the end of this completed fiscal year. So there was a dichotomy or divergence between the definition of the SEC and under the Code Section 162 for who is considered a covered employee. The Tax Act repeals the commission and performance-based compensation exceptions to the $1 million annual limit on the deduction for compensation paid with respect to a covered employee of a publicly traded corporation. So the question becomes then, all performance-based compensation, including commissions, is now subject to the $1 million per year non-deductible definition. So going back into covered compensation or covered employees, the definition of a covered employee has also changed under the Tax Act and now includes the principal officer or CEO and the CFO and the 3 highest paid employees. So they've added and they've moved into more of a definition in alignment with the SEC for the purposes of defining who's a covered employee. In addition, once an employee qualifies as a covered employee, the deduction limitation applies, and that person is a covered employee as long as the corporation pays any income to that person or their beneficiaries. The definition of a covered employee, or this new covered employee definition, is effective for tax years after December 31st, 2016. So this definition of a covered employee is in effect for the 2017 tax year. This is a significant change for many clients. What does this mean? It just means that any type of deferred compensation is subject to the $1 million deduction limitation, even if it's paid to an officer after they cease to be an employee. So even if these covered executives, once they become a covered executive, they remain a covered executive, and after they leave the organization, they are still considered a covered executive for the $1 million limitation purposes. The new Tax Act also expands the categories of public companies subject to the deduction limitation. So prior to the Tax Act, the Section 162, or this $1 million limitation, only applied to companies with registered class of stock or securities. It will now apply to any company that's required to file public reports with the Securities and Exchange Commission, SEC. So the expansion of this $1 million limitation or deduction cap has now been expanded to other organizations or businesses that have to file reports with the SEC. There's a transition rule that applies. So these changes do not apply to any contracts that were written and in effect on November 2nd, 2017, that have not been modified in any material respect after that date, on or after that date. So if there were contracts in place for performance or commissions, these new rules do not impact those contracts in place if they were in place on November 2nd, 2017. Moving down to qualified equity grants, 2017 Tax Act offers a new tax planning opportunity for private companies as long as they widely distribute stock options or stock-settled restricted stock units to their employees. So what does this mean? If a company distributes stock options or restricted stock units to at least 80% of its U.S. employees, and the control group rules for this purpose are considered when you look at the 80% rule, an employee other than a 1% shareholder, the CEO or CFO, or one of the top 4 highly compensated employees or officers during the year can elect to defer income associated with the stock option exercise or RSU settlement for up to 5 years after the stock option exercise or settlement, RSU settlement date. So what this really means is, except for the top 4 highly paid compensated employees, CEO and CFO, your rank and file employees, or the 80% group of employees, are able to defer income on these RSUs or stock options. If the stock delivered or upon exercise or settlement is unvested and non-transferable is important, the employee can elect to defer for up to 5 years the income associated with that stock vest. The amount of tax will be based on the value of the shares at the time of the option exercise or restricted stock settlement, or at the time of vesting or transferability if later. Options or restricted stock units granted after 2017 must have the same rights and similar privileges other than grant size provided to each employee, and they have to be more than a de minimis grant to qualify for the rule. So in other words, in order to meet this 5-year exception and to push off income and to have this qualify, the grants have to be offered and issued more than a de minimis amount to employees. The provision applies to corporations only. It does not apply to limited liability companies taxed as partnerships, and it's only to grants made to employees. So non-employees are not eligible to use the qualified equity grants. Section 83B elections may not be made with respect to restricted stock units. An employer is required to give notice to employees who issued qualified employer stock, and the employee has 30 days after receiving the stock to make the election and revoke the election at any time. New rules apply in addition to this, and they do not supersede Section 83B election regime. Those rules are still in place. and they relate to qualified stock options, incentive stock options. The rules may not be combined, however, so you have to pick one of the stock option regimes that you're going to be working with when you start looking at qualified equity grants. If an employee elects to take advantage of the new rules with respect to an incentive stock option, the incentive stock option treatment ends. There's a transition rule that the IRS is issued. They have some time to issue some additional regulations and guidance regarding implementing the 80% rule and employee notice requirements. An employer is going to be treated as complying with the rules if they use reasonable good faith interpretation. The effective date of applying the qualified equity grant option or opportunity applies to all stock options and restricted stock units settled after December 31st, 2017. So what does this mean to employers, and how can you look at some of these rules and apply them to your business purposes? All businesses who offer certain types of fringe benefits to employees, such as the transportation, moving expenses, meals and entertainment, employee achievement awards, will be impacted by these rules. Any employee who receives these types of benefits or is offered the opportunity may be impacted by these rules. Some of the provisions will sunset and return to pre-tax law. Most of those will sunset after 2025. Some will be transitioned over the next couple of years and be completely disallowed after 2025. So while these rules are in place right now, care will need to be taken in looking at these to make sure that you're following the current rules for the year when you apply some changes. Some of the challenges facing employers are going to be reviewing payroll reporting systems and revising as necessary. You'll need to capture all the reporting and payroll and changes to your systems for W-2 purposes. You'll want to determine any other type of fringe benefit programs that the Tax Act will impact and consider possible workaround strategies for the business and your employees. One important item is going to be reviewing any outstanding employment offer letters and reviewing the potential tax impact. So offer letters that are outstanding as of December 31st, 2017 will be impacted by these changes since all the changes are in effect currently. So if you have letters out there that will offer certain benefits to employees, you'll want to take into consideration the tax impact or the additional impact to those. Another area of concern is going to be the executive management team and the benefits. And many executive team members will have severance or separation packages, employment agreements. Those will all need to be reviewed with regard to these changes to see if, in fact, they are going to be impacted, especially with regard to the Section 162 $1 million limit. Non-qualified deferred compensation plans will also be taken into consideration for the $1 million limit, and non-qualified or these types of payments are considered wages for this purpose. And so care will need to be given in possibly restructuring changes to try to capture as much of a deduction as possible if you are paying executives in excess of $1 million. The transportation benefit is immediate, and so you'll be wanting to look at that right away and make sure that you're capturing that properly for your employees. If you do not have a pre-tax plan or benefit transportation program available for employees to use, you may want to consider implementing one of those. Meals and entertainment expense reporting will also need to be reviewed and likely changed. This will be an immediate impact to most, if not all, businesses, and care will need to be taken to categorize your meals and expense items differently. And so there are questions out there right now regarding what is meals, what is entertainment, and one of the items is if I take a client to a sporting event or I take them to another type of an event where there's possibly meals and entertainment combined into one price, I believe that you're going to, if you could, separate the two items out or the whole event will be non-deductible as entertainment. So you'll want to carefully review any type of impact to those items. The accountable plan rules under the Tax Act did not change, so you'll want to make sure that for the programs, if in fact you do need to make changes to your benefit programs, that your accountable plan rules, that you're using those so you do get to take the tax break if possible or if available, and your employees will not be taxed on any benefits you provide. Other benefit programs may be impacted by the Tax Act. One of the items that has come up that will be impacted is the idea that if you increase compensation to employees for purposes of moving expenses or for purposes of maybe meals and entertainment or transportation, that compensation typically is included in the definition of compensation. So for retirement plan contribution purposes, that now increases compensation that may be used for contributions to the plan. So these are all items that you'll want to carefully review when you're going through your benefit programs in general. The timeline for these changes, the first quarter of 2018 would be the recommendation to review all benefit programs, and the tax impact would be transportation, meals and entertainment, moving expenses. These will all impact current payroll reporting, and you'll want to make sure that you capture that information properly. During the second quarter, you may want to review employment agreements and settlement agreements and equity programs if, in fact, you have those types of programs. It's important to discuss any type of internal reporting system changes in payroll now. You'll want to consider how to communicate these changes and any impact to your employees regarding transportation or meals and entertainment expense policy changes. Review your policies and accountable plans, and look at how you move and work with your business associates and employees. The inclusion of previously excluded benefits and employee compensation, as we said, may impact retirement plan contributions and other benefits. If you have any questions, please feel free to reach out to me at my phone number or email address.